Our next guest called Lyft's decline and the success of Pinterest before those companies debuted. Let's show you what he said.
Snap scored a 5.91 and Pinterest does a 6.63 versus an average of 6.3. Right, so Pinterest is well above average in the scoring system, and we think this deal will reflect that, and it seems to be shaping up to do that. It was a low score, 5.47 Lyft score versus a 5.91 for Snap, right? So we were expecting, not good things out of Lyft.
So what does he predict for Uber now? Joining us right now is Rett Wallace, is the CEO and founder of Triton Research. Good morning.
Morning.
So what do you predict for Uber?
Well, I think the first thing that's important to say is Uber's not like the other deals.
Okay,
this
because
is so much bigger. This is sort of a once in a IPO cycle thing, like Alibaba, for example. And so it's hard to say that it's going to behave like all of the others. On the other hand, as far as this is why we score them, is that there were a lot of things to not like about the 500 pages of disclosure, but the score comes out at a 6.35, so it's straight down the middle. Not Pinterest, not Zoom, but not Lyft either. So actually, as much as there are things that you don't like about this thing, the score says it should be fine.
Okay, because you're sitting next to a board member of Lyft, explain to us and to her why you feel or why you were more confident in Uber's IPO.
Well, maybe I'll
Lyft's.
keep it grounded in the scores and on the facts as opposed to our opinions about these things. But basically, look, the Lyft loss profile was much more significant than Uber's. Right? And so when you're losing $1 billion of EBITDA and $2 billion of revenue versus losing $3 billion on $11 billion, it's just a different sort of story. I think also Lyft opened the market for everybody. So as much as people didn't like the way Lyft traded, look, WeWork with $2 billion of losses is now filed. That means the market is open, and Lyft did that for everybody. So there's a lot to like about what they did, and they took one for the collective unicorn team.
For Uber, do you take into account the unrealized gains from some of their investments as well when assessing their loss profile? Because that's one difference that Uber has compared with Lyft.
Sure.
Because they have all of these investments that they've effectively made paper gains on that they haven't really realized.
Sure. I think that, look, that's one of the things to not like about the complexity of this story. Right? There are a lot of things to not like about all of the sort of partially owned interests, including even freight is partially owned if you sort of dig into it. And so, no, those things are really much less important than, does the core business make money at some point? And I think that's what people are really looking for. And also, investors on the road today, or that are part of the roadshow will want to know, can we unscramble the eggs of rides and eats, please? Because it's going to make it a lot easier to evaluate.
Question, which is, there's been a lot of comparison made between Uber and Amazon. And I think that's a comparison that Uber's wanted out there.
Of course.
Right. Is that an appropriate comparison, given when you look at both of those companies and where they are in the stages of their life when both went public? Because I would argue they were in different places.
So I think that's right. They are in different places. But the other thing we'd say, having thought about this for a minute, is yes, the size and the sort of, we're going to take over the world or bust kind of mentality is there. The difference is Amazon didn't have World War III going on with regulators and class action lawyers all over the world. And so if, what we found ourselves saying is if Amazon had its pricing regulated, had been outright banned in whole countries, right, Amazon might not be Amazon. And so Uber's, I think, profile as far as what they have to accomplish to get to profitability is just going to be tougher than what Amazon was up against.
The other thing to keep in mind, Lyft has been very disciplined about where we play and our right to win where we play before we go play someplace else.
Yes.
We don't put checkers all over the board and then hope for the best and get into a lot of trouble in a lot of different places. And the regulatory environment for ride sharing is different in every single country and totally expensive. So I kind of look at it and say the mighty can fall, and they fall hard. And there's a lot of risk in those pages.
Sure.
Right? And
48 pages of risks.
That's exactly right.
But when you're making these predictions, you're really predicting how the stock is going to fare after the IPO, but for how long after the IPO?
So look, the primary deal when investors buy at 72 and it opens at 87, that is where the score really matters the most of the time.
So this is a short-term bet, effectively.
Well, look, there are things that will influence how long the period is before things adjust. Lyft, because it was so high profile, a lot of people really focused on it. Right? Some things take longer to adjust than others.
And the first in the category to go out. So,
but I think back to what you were saying as far as knowing where to play, the other thing that you see in Uber's numbers very clearly is that Lyft can have a very big influence on Uber's profitability when they decide to take share.
Correct.
Right? And so what it means is these two, even though Uber is so much bigger than Lyft, have to learn to live with each other at some point, or else nobody will ever make it.
Wait, have to learn to live with each other, meaning conspiring to set prices?
You would never admit to doing that, even if you did it. But basically, you have an example of what happened with Uber and Didi, right, where they had to come to terms with each other because it just wasn't working. There weren't enough billions in the world to fund that war. And I think what you see as far as the aggregate profitability of the two companies, which is, we're in an unsustainable place, I think is what you would say, even not including, our drivers' employees, do prices get regulated and all those other factors.
Do you think, given how the stock of Lyft has performed, with apologies, and I know we'll see where it goes, and hopefully it'll get better, but that
I think you should have some coffee.
That Uber has that Uber has taken its price down in the same way that people looked at Pinterest and thought maybe they were too conservative, that maybe Zoom was too conservative.
On price? Well, look, I mean, do you include all the dilutive shares? Like, people are saying 80 to 90, but really it's kind of 90 to 100, right?
Right.
And so, is that conservative? Well, that's positioning. And, look, none of these things trade on fundamentals.
Right,
This is all about perception.
I hate when people talk about the lower number, the lower share number, to say that not the fully diluted. You've given those options away. You've given that stock away. It should all be concluded.
It's 90 to 100, right? The math is right there for anybody who wants to, again, dive into this thing. It's very clear what the pricing is. And so, look, is that a super big bump over where they were in the private market? No, but as we've seen, stocks can go up and stocks can go down.
Yeah, and I think you also have to look at the culture and the acceptability of people that use these services. And I think that the Lyft culture is a very healthy culture. It's very employee-oriented. It's about doing the right things at the right time for the right
Is it doing the right thing, period? That's what I want to know.
Period.
That's what Uber says they do.
Yeah, well, I think actions speak louder than words.
Although I think under Dara, things have changed. It's not the Uber that it used to be. I mean, that was a good argument to say the culture was totally different.
Totally agree that things do
Kalanick.
change.
Yeah.
But at the end of the day, it's what happens in the long run that matters.